Now let us see what effect net profit has on the business value. To do this, we look at a blue shaded area again and copy and paste the value to the white area. So we'll go back to the data entry tab and look at our net profit. Let's delete any adjustments because we'll examine that later. So let's see what our net profit is. Okay, at this point we have a 75% net profit, cash flow $150,000, and then business value $2,490,000. So there are no adjustments here. So net profit equals cash flow. So we copy that and we paste it. Now let us make a minor adjustment. Go back here. Let's say the owner underpays themselves $50,000, but at the same time has $10,000 discretionary expense in the business. Well, that's $10,000. The $50,000 you'll have to subtract it, because if the owner was to sell the business or was to hire somebody, they will have to pay out that $50,000. And discretionary expenses, we add that back in, because if I were to sell the business, that's an expense the new owner is not going to have. So let's see what effect that has on our net profit. We see our net profit percent is now 55%. And at that point, our business value is $1,788,000. Copy that. And we paste that. And also we can see that that doesn't affect cash flow yet. So now let's look at the factors that affect cash flow. So we go back to data entry general. We say we put depreciation of, maybe we had depreciation of average of $10,000. We have total current assets of $50,000, but liabilities of $10,000, current liabilities. And then we pay $500 a month in debt. On an average, we buy like $5,000 in capital expenses. Now, those capital expenses are expenses that we pay, like for an average, we pay for assets. So on average, you might buy maybe a computer a year, or you might buy some equipment. So whatever you buy for those capital assets, that's what you put the average of that in the year. And normally you get that from your balance sheet statement and get the average over 2 years and see what you spend on average in assets. So now let's take a look at our results. We see that our net profit is $110,000, and we see cash flow is $74,500. And that's because there's the depreciation. If you look back here, depreciation is added back in because it's a non-cash expense, so that's a cash flow adjustment. And then we have to think about the working capital needs, because basically that owner, when you sell the business, the owner has to provide that back to the business. So that's $40,000 they have to bring back into the business. So that's a cash flow adjustment to them. And then whatever long-term repayment you have, if you're taking over, they have to account for that. And also what the average capital expenditure is, it's not taken into account on the income statement. Well, they have to put that as part of the cash flow, because that's money they have to have available to buy those capital expenses so the business can keep making profits. So we see the cash flow adjustment here is $74,500. And at that point, the business value goes down to $1,200,000. So we copy that and we paste that. So far, we're saying just because you're profitable does not mean a new buyer, a new owner will find you profitable. There's certain adjustments that have to be taken into account. For example, the excess officer's compensation. Well, if you're underpaying yourself, the new owner might want to hire a manager, and that's money they have to pay out. Discretionary expenses work in your favor because it's added back in, and so does depreciation is added back into cash flow. The new owner also has to take care of working capital needs, and if you don't have enough cash, that's even more cash they have to come up with, because they have to meet your working capital and any shortfalls you might have. And then if you have long-term debt, that's something they take on, that affects your cash flow. And then your average capital expenditures, well, they have to make sure they have enough money to meet those capital expenditures every year. So those things affect your cash flow. So now next we'll look at how other factors will affect your business value.